there's adjustments. You're not going to necessarily have a plan that you set when you turn 62 and retire that you're just going to stick with for the next 25 to 30 years. Like you might need to make some bigger adjustments.
All thoughts and opinions shared in this recording belong to the participants. This podcast is meant to inform and educate and should not be seen as solicitation or endorsement for business. The advisors discuss some of our firm's investment processes. These are just a few of the many possible approaches to investing. Individual results may vary depending on your goals, risk tolerance, market conditions, and other personal factors. Please consult a qualified financial professional before implementing any investment strategy.
Hello, welcome to the Market Moment. This is Matt here with Lee.
Good morning.
And John.
Good morning.
And got two topics we want to talk about today. So as always, we appreciate you guys joining. Give us a like, subscribe, comment, shoot us an email. Be nice in the comments. And send us over any questions that you have. We like reading those and talking through some of them and answering questions if we can. So today, the kind of commonly asked question that we're going to talk through is, what is the ideal asset allocation I don't know what the actual question was, as you enter into retirement or for
what should your asset allocation be?
Yeah,
as you enter into retirement.
Okay, so we're going to talk through that a little bit and just things to consider. Obviously, like a lot of these questions, there's not a fixed, set, perfect thing that, allocation that applies to everybody. So that's probably assumed and understood. But talk through some things to consider there, and then we're going to get into the markets a little bit after that. So as you're talking to clients, meeting with clients, whether they're new clients, existing clients, and they're someone who's transitioning into retirement or thinking about that, or maybe right after retirement, what is kind of a general rule of thumb or kind of a good starting point when you're thinking about asset allocation?
Well, it's kind of funny because I think there's general rules, right? You get more bonds in your portfolio the closer you get to retirement. When you're in retirement, you kind of, you trend more towards safety just because what you've accumulated, you want it to last the rest of your life. So you have to kind of protect and defend when you're not putting more, you're not putting money into your 401k anymore. You're drawing off of it. You can't afford a big market downturn. It could destroy your retirement plan, right? 2008, people retired if they had all their money in investments when the financial crisis happened and the market went down 54%. Imagine your portfolio right now. If it's all in equities, you retire today and the market repeats that, goes down 55%. Can your retirement withstand you taking money out of it while it's going down 55%? In most cases, that is not sustainable, right? So I think that's the common thing. Now, one thing I see on the flip side of that, a lot of times if you just use that same montage of, we've got to get very, very conservative, sometimes you can get conservative. Because remember, if you retire at 60, today we're living longer. So if you live to 90, you have 30 years that money has to work for you, right? So if you're only making 4 or 5%, but you're drawing out 6, 7, 8% to live on, I mean, there's some math equations we have to do for clients and kind of talk them through that. I think everybody, as we've said on this a million times on all these questions, it's a relative answer it's a specific answer to the specific case that we're working on. But I do see mistakes made. The other thing I'll say, one thing I do see a lot of that I think is a mistake, is I've had clients come in, they're 65, 67, 70, whatever. And there's strategies that we put together for clients, a lot of them, and people might have heard of like the bucket strategy or the ladder strategy, where you build out CDs or some type of fixed income, some type of safety that comes due years, 2 years, 3 years, 4 years, 5 years, 6 years. So the money you're living on, each 2 year, 3 year, each year period for the next 6 or 7, you have something coming due to replenish that bucket. And sometimes I'll get feedback from clients that, no, I can't do that because I don't want to tie my money up and have my money tied up. And they're thinking really short term, like we want it to be liquid, but you're not going to use that money. It's to last until you're 90.
Right. Yeah,
right?
It's
so
easy,
you can ladder out, and it's fine.
Easy to get too conservative or too short-term minded when you're, because fear kind of sets in, and just the unknown. And it's like, well, I've worked so long to accumulate this, and I get that. Those are all natural, emotions and feelings. But because of longevity, because of income needs, there's risk to being too conservative too soon,
Right.
as well. And so it's something you have to definitely be aware of. Lee?
I agree with.
So it ties back to like the actual asset allocation, because that was kind of the question. Like when you think of someone retiring, what's a standard kind of allocation that people might think of, or that you would maybe recommend?
And then I want to say depends. I know that's not what you're looking for as an answer.
It's not.
Now, thank you. Now, I think there needs to be diversified. I think you do need some bonds in your portfolio. I not necessarily for income, but for some diversification. I think that's why, and John has said it not only on this podcast but many others, is your risk profile, that's important. And you may be an aggressive investor, or somewhat of an aggressive investor, even in retirement. If you have no income needs from your portfolio, then your portfolio is going to look very different, or potentially very different, from an investor that needs to draw some form of monthly income from their portfolio. Now that rates have improved, I think that bonds can make some sense. I think that some type of income stream, whether it be a type of an annuity or something that can generate income, I think that has a place in a portfolio now. I think a general rule, you don't need 100% of your portfolio in the equity markets. You just don't.
Right.
Do I think that there is a certain percentage, 60%, 50%? I really don't. I've probably been a little bit more aggressive with some of my clients as they've gone into retirement, because just up until the last 5-6 years, the fixed income markets were not attractive. And so even for clients that needed some income, you were better going into the equity markets to get income than depending on fixed income or bonds. And so I think now that we've had rates at higher levels than we've experienced in the past 10 years or so, you have more diversified portfolios, equities, bonds, and then these fillers, whether it's index annuities or a type of an annuity to provide for income.
And not to mention gold and silver and Bitcoin, all these weird outlier things that we don't talk about all the time. But there's been a lot of ways to get out of equity markets and make money.
So since these guys are beating around the bush and won't answer the question, I'll just address it. So
what is it?
I think if we're trying to put a general rule of thumb that probably is most applicable, because everything y'all said is 100% right. It depends. There's so many different variables. Most people should probably be in the 50 to 70% equity allocation, kind of when they're thinking about retirement. There are tons of exceptions. There are tons of people outside of that, and there are a lot of reasons that you should have more equity exposure or less equity exposure. But if you just kind of added everybody up, I think most people probably should have somewhere between 50 to 70% equity exposure, and then 30 to 50% in fixed income, or go buy an income annuity to guarantee some lifetime income, or buy some CDs or buy some fixed annuities, or some kind of money that's not directly tied to the market, that's providing that consistent income, the volatility kind of buffer, the diversification.
Yeah.
That's fair, right?
Yes.
That's kind of
That's
probably
fair.
the biggest bucket that most people fall into.
He said in 45 seconds what it took us 8 minutes.
I know.
No, well, it's just,
Yes.
that's kind of the very broad way to look at it. 50 to 70% is probably applicable for a lot of people. So there's so many factors that go into that. We always talk about, as you get close to retirement, you should really try to solve for income first, right? Mm-hmm. Retirement is an income calculation. So it's where are we going to get income from? So if you get income from, Social Security, pensions, you buy a lifetime income annuity, you have rental income, then your investable portfolio you could probably be a lot more aggressive with it because you've solved for income in all of the other ways. If you're solving for income by, hey, I'm just going to take withdrawals off of my investment portfolio, you probably shouldn't be 100% equities.
Right.
Because a downturn or volatility is going to be much more impactful, especially if it's longer lasting. So a lot of factors, like John and Lee said, that go into it. But, you hear so often the 60-40, kind of the standard, most commonly kind of talked about, understood portfolio for someone who's nearing or in retirement. And I think generally that's still like a good place to start. And then you kind of deviate from there depending on your specific situation.
Correct.
Yeah.
That's safe.
So,
all these questions we've been given, like we did a list of all the most commonly asked questions, and that's what we're going through when we do these podcasts. And they're all overlapping, right? They all go to each other. Like, how much can I end in retirement? When can I retire?
You're kind of answering the same question.
You're answering the same question in different ways. And it's basically get a financial plan. That's probably the best thing you can do for yourself. If you have these questions, go talk to a financial planner, advisor, and they'll help you, guide you through it. And then most out there are smart enough to know how to allocate once they know the whole entire story of the person.
Right.
Correct. And they can help you. And that's the main thing. I mean, we can go in circles and all that stuff, but you're right. And then we're right with all the variables. And then it's all just lumped into one thing. Go see an advisor.
Yeah. Just don't get too conservative too soon unless your situation, really needs it. But then I say that, and I also say, I've talked about many times on here, like the retirement red zone, right? You can Google that. I didn't come up with that. It's a thing out there, right? But kind of the time to make sure you're most aware of significant drawdowns and the impact that they can have. And so those years right before retirement and right after. So, there's adjustments. You're not going to necessarily have a plan that you set when you turn 62 and retire that you're just going to stick with for the next 25 to 30 years. Like you might need to make some bigger adjustments.
I thought it was Go ahead.
Well, I'll just say the best point that I heard in here so far was that you solve for income.
Was it something you said?
No, you said. If you solve it for the first time, it was something you said. If it's solving for income, and you know what income you need through retirement, and you solve it through whatever ways, then everything else is gravy. It really, then you can it doesn't matter your diversification. But if you end up solving for income and you need every penny to work for you, then it does matter. You can't go through a 54% downturn. In other words, okay.
Quickly, yesterday, I'm sitting here looking at a headline on CNBC.com that 401k plans saw a flight to cash and bonds in September. And so don't know what triggered that. It could be the volatility, could be government shutdowns, it could be anything. But I just think it's funny that on the heels of our conversation, yesterday's headline that September flows to 401k plans saw a flight to cash, stable value, and safety. Interesting.
Yeah. So on that note, let's talk about volatility. So we had Friday, market turned over, sold off a little bit. Pretty solid day in terms of a sell-off. Yesterday the markets bounced, so we were up, gained back a little bit more than half of Friday's sell-off. The markets opened down over 1%. Nasdaq's down almost 2% at the open, or just after the open this morning. So thoughts on the last few days? We have a little bit of a whipsaw here, sell-off, comeback, sell-off.
I think there's several things. One, it's obviously tied to tariff talk again.
China.
Everybody thought that that might be over. It's not. But I think the markets have done so well this year, okay, in a year that really most people did not anticipate. And so anytime you get a headline like we got on Friday, people don't need much of a reason now to take some profits. And they did. Then, of course, Sunday, President Trump makes the comment, China's not a big deal. We're going to be fine.
Yeah.
And the markets get back pretty much half of what they lost on Friday.
Yeah.
Today, the volatility's back. And so, volatility is normal.
Yeah.
And what's interesting is the points look big, but when in reality, the markets have gone up so much that a 500-point, 600-point drop on the Dow is less than 2%.
Yeah.
And so I just think it's a combination of There's still uncertainty. The government shutdown now enters its third week, and you've had a great market, and people just don't need much of a reason to take some gains. Put some cash in their pocket.
My little thoughts on it. China was the big thing on Friday, right? As soon as Trump said that, at midday through Friday, the market went from being up to being way down, right, in a very three-hour trading window time frame. And you hear that story about people have moved their money to money market and got out of the market in September. And it's kind of funny to me, but the overall market's actually performed really well in that month. Now you flash forward to right now, China, yes, always going to create problems. Although, again, personally, I'm totally fine with what we're doing. But our November 7th, the next jobs report, which we didn't have one in October, but the next jobs report, November 7th, and that's going to follow all of these earnings coming up here in the next couple of weeks that are big earnings season. And Matt, we were talking about this before the podcast. Like, it seems like we have earnings all the time. It's like the Fed meeting. It's like every day we talk about it. Well, earnings is coming up. That's important for me to see the future cast, I think, of what the companies are forecasting going forward, not necessarily what they're showing from the previous quarter. I'm going to be real interested in future, and then a jobs number in November to me signals whether the economy's getting weaker or stronger, because it has shown signs of weakness, and that is something I want to pay attention to.
The job
in general,
the job market's weakening. I think we can all agree that is the part that the Fed is looking at in order to justify their rate cuts. But let me tell you what's going to happen in November. I think there's going to be an asterisk by this jobs report in November because of the layoffs in Washington.
Oh yeah, they'll parcel that out though. They will.
Yes, but
They'll show us.
so it may look even worse than it probably is, simply because if this government shutdown lasts another week or two, you're going to see more layoffs, and so
I not to oversimplify it, but I'm going to oversimplify it. Market's done well. Market's at a high point. Market's trading at, I'm not saying, it's not priced to perfection, but it's
overpriced a little bit. Yeah.
It's stretched a bit just in terms of valuations. Now, earnings keep coming in, right?
Sure.
I mean,
keep
it's
catching
not
up
like
to
it's not
expectations.
Yeah, I mean, there's some validity to it. It's not just like crazy.
Yeah.
But you get a little bit of bad news and the market sells off. Like there's more to me that likes that than that doesn't, because if the market doesn't react to negative news or we don't see a little bit of a pullback after we've seen a strong rally. I mean, the rally that we've had since coming out of the April lows, I mean, it's like the market's up. I don't even know what. I mean, it's huge, right? And so to see a 2, 5, 10% pullback in the market, nobody likes it. It's not fun. We would rather it just compound at 5% every month, forever. But
we did talk about that last week. I think it was the first time or one of the only times in history that the market from the low to the high, 33% return in 6 months.
Yeah. And so it's like this is just to me a sign of like, you want a healthy market reacts negative to negative news.
That's correct.
And periodically you get a little bit of a pullback or correction. Like that is, you've heard the term like bubble a lot lately, right?
Yeah.
Are we in an AI bubble? Are we in it? And there's been a lot of people, it's kind of to my surprise, that have come out and said, I don't think we're there yet. Even like Howard Marks, I was reading some of his remarks the other day. He's like, I don't think we're in this like true bubble environment yet. If we were, the market would just continue to rip ahead,
correct,
kind of regardless of what's happening. If we're in a healthier environment and market, the market reacts negative and we go through pullbacks. And so as much as we don't like it, as much as we like to all log in and see green across the screen, it's normal. And who knows where this goes with the China stuff. Does the market may remain volatile for a period of time, but I think it's all thus far just normal, healthy market reactions to news.
Yeah. I'm going to go back to 1720. We're going to do it's going to take another hour, but I'm going to go through all the inventions that have happened since 1720. No, I'm kidding. But it started about 1720. Yeah. Think about all the massive inventions that have happened in the U.S., right? You go back to the 90s, and you had, you remember WorldCom? Yeah. You remember all these companies are no longer in existence now, and it was this new technology. AI, obviously, we feel like is different. It's like it's helping, it's doing it, but is it actually adding to profits in companies, or is it going to take away? And we don't quite know some of these results of this.
There's still a lot of unknown.
Yeah, still a lot of unknown. What I've seen when I look back in history, a lot of times we overvalue the early part of a new thing,
New innovation,
and then we undervalue the long-term
Sure.
greatness of something,
Sure.
right?
The
And,
difference,
yeah.
100%. And I think the 90s, the dot-com bubble
Yeah.
is often kind of, used an example of kind of
Yeah.
what's going on. And I get it. There's some similarities just because it's technology driven and it's right. But, the difference there, the markets are so different now than they were back then.
Yeah.
In the 90s, hundreds or, I don't know what the number is, 1,000 tech companies. The best way to raise money was the IPO. Right. And so you had a flood of these small tech companies, internet-based companies coming into the market and then just soaring, right? That a lot of them ended up being completely worthless.
Right.
And literally going out of business.
Exactly.
And you don't have that same you don't have that today where, a lot of those companies are either just getting swallowed up by the big companies. Right. And so you never know if they make it or not because they're just end up being a side project for Google or Amazon, Microsoft, or they're just staying private for a really long time because there's plenty of money. And so in terms of the impacts on the public markets, I just think doesn't mean it won't be a bubble, doesn't mean it couldn't turn into that, but I don't think the dot-com bubble in terms of the impact on the public markets is going to look that similar to what it was in the, around 2000 because of just how much everything has changed. So
do we have... Here's my ignorance, John. Do we have a lot of companies, new publicly traded companies that are strictly AI?
Yeah. You mean talking about small cap, new on the market? There are rivals of like the big boys. There's some names that I see for sure. I guess,
but there's not a lot.
But not a lot. No, it's mainly.
And I'm kind of thinking back to the .com when like you said, everybody was going public.
Yeah.
Whereas,
no, it's not.
Whereas
like that.
now, it's all the big boys. Just getting bigger.
Yeah.
They're
driving.
Who are the leaders in AI?
Yeah.
It's Google, Microsoft, Meta.
Well, if you're a founder of one of these companies, you just want a check.
Yeah.
And that's what it comes down to.
Exactly.
And so if you can get that check in the private markets by either raising capital or just selling, then why go through the headache of trying to go through an IPO?
Correct.
Right?
Correct.
And so you just don't have to
So
do
the
that.
NASDAQ pullback in 2000, coming off that, but there was a lot of fake companies that were made, like shoe.com or whatever. Just a bunch of stuff thrown together, put on IP. For some reason people bought them and all that, and then they completely crashed. The market, the NASDAQ, if you remember, at the end of that downturn, it was less than 2,000. The NASDAQ is 22,600 right now. Right? It was at 4,000 something, the tech bubble crash, or 5,000. Came all the way down below 2,000, and it was all those. But the technology that was created that boom, that ended up creating the bust. The technology is what drove the markets forward to today.
Yeah.
And now we have new technology. This is kind of the AI thing and of course technology is new every day, but it is. I think it's a much healthier market than, for example, the 2000 market for sure. And you're right. The stocks are, for the most part, the bigger companies. The smaller companies that are trying to compete are also either being gobbled up, they're partnering, whatever. It's a different market.
Yeah.
Healthier companies are leading the way.
So and the volatility that we've seen the last few days, just it's when the market's done as well as it has, it's always kind of a surprise. It's a little shock when you're like, oh, market sold off 2%. Like that's a bad day.
Right.
We're spoiled.
Yeah. So it gives us something to talk about, though.
Yeah.
And, we'll see. I honestly think everything will be fine with China, over the long term. But, doesn't mean that there doesn't need to be some hard decisions and things done along the way. So, anyways, all right. Any parting thoughts or words before we wrap up?
No, it was good.
Okay. Well, good conversation. We appreciate you guys. As always, we get a lot of feedback from clients and people watching. Some of it's positive, a lot of it's not. No, I'm just kidding. But a lot of good feedback from you guys, so we appreciate you watching. Give us a like, subscribe, and we will see you guys next week.
The hosts of the Market Moment podcast are employees of Mach 1 Financial Group, LLC. Mach 1 is a registered investment advisor located in Rogers, Arkansas. A copy of Mach 1's current written disclosure brochure is available through the SEC website and available at disclosures.mach1fg.com.